Let's say your goal is simple. You want to earn $2,000 a month. Not from some side hustle, not from flipping coins on crypto. Just solid, dependable dividend income. You've seen the charts. You've probably heard about monthly dividend ETFs or funds promising 10% yields. And maybe, just maybe, you've wondered, is this actually possible for someone like me? Especially if you're not 25 anymore. Well, this video is going to answer that. We'll break down exactly what it takes to hit that $2,000 per month target, what traps to avoid, and how to build a dividend portfolio that doesn't keep you up at night. Because investing isn't about rushing, it's about sleeping well while your money works for you. So, let's get real with the math. If your portfolio yields around 4%, you'd need about $600,000 to generate $2,000 per month in dividends. But here's the catch. Most funds that yield 4% are lower risk, slow growing, and take time to build up. And more importantly, in today's high interest rate environment, a 4% yield is no longer particularly attractive when you can earn close to that from short-term U.S. Treasuries or money market funds with virtually zero risk. Now, maybe you've seen ETFs with 10 to 12% yields, like QILD or MVD, and the numbers look tempting. At 10%, you only need $240,000 to reach that same $2,000 a month. That's less than half. But here's where it gets tricky. Those funds come with something investors don't always realize: limited upside and sometimes decaying capital. So before you chase yield, let's talk about two strategies. One that feels good today and one that quietly wins over time. Let's start with JEPI, the monthly income king. Right now, it yields around 8 to 10%, paid out every month like a paycheck. And when you're close to retirement or just want cash flow now, that's a dream. But that yield comes from a method called covered call strategy. It's a way the ETF makes money by selling something called a call option. That means it gives someone else the right to buy a stock if it goes above a certain price. In return, the ETF gets paid a fee up front. You can think of it like this. Imagine you own a house and you rent it out. You earn steady rent, but if the value of the house suddenly doubles, you can't sell it for that higher price. You already promised someone else they could buy it at a lower price. That's what happens with covered calls. You get steady income, but give up big profits if the market goes up a lot. This makes income more stable, which is nice, but also means the ETF can't grow as much when the market is doing well. So, over time, you might earn money every month, but miss out on big gains. Now compare that to SCHD. It's not flashy. The yield hovers around 3.8%, and it pays quarterly, not monthly. But here's the quiet magic. Over the past decade, SCHD has consistently increased its dividend. If you'd bought it 10 years ago, your yield on cost today could be over 10%. That's real compounding. In 2012, SCHD paid around $0.81 per share. By 2023, it paid $2.65. That's more than a 3 times increase. And no, it's not a fluke. This is what Warren Buffett calls the snowball. The dividends don't just pay you, they grow. And that growth is what changes everything. Of course, these two funds, SCHD and JEPI, are just examples. They're popular, accessible, and easy to understand. But they're not the only options out there. The key is to understand the strategy behind them, whether it's income now or growth later, and choose the tools that match your time horizon and goals. Now that we've seen how two very different strategies work, one focused on monthly payouts, the other on long-term compounding, let's talk about how to actually use them. Because your ideal strategy depends on your timeline and goals. Let's break it down into 3 realistic paths depending on where you are. These aren't rigid categories. Many investors actually move through these phases over time. You might start with the long game in your 30s, transition to the 5 to 10-year mix in your 40s or 50s, and finally lean into income-heavy ETFs as you approach retirement. Also, keep in mind, All three strategies assume your basic living costs are covered by this income. In real life, it's smart to keep 3 to 6 months of expenses in cash or ultra-short bond ETFs like SGOV or SOV, just in case. That buffer helps you avoid selling when markets are down. And if you're using tax-advantaged accounts like a Roth IRA or equivalent ones, these strategies can work even harder. Tax-free reinvestment is a quiet superpower in long-term dividend growth. Before we dive into the three paths, let's get practical. Depending on your stage of life, you'll need a different balance between income now and income later. Whether you're already retired, planning for it soon, or still growing your portfolio, there's a strategy that fits. Here's how that might look in practice. The first is for someone who's retiring soon or already retired. You'd build around high-yield ETFs like JEPI, QYLD, and MVD. Maybe add some rates and even a short-term bond ETF like SOV. Yes, you'll get your $2,000 a month at a lower capital base, around $240,000 to $300,000. But you're sacrificing growth, and you need to accept capital risk. This isn't a forever portfolio. It's a bridge to get you income today. Now, what if you're not retired yet, but you're not that far off either? This is the sweet spot. You might blend SCHD for growing income, JEPI for monthly stability, and include some broad equity ETFs for future growth, all while keeping some cash or bonds to manage risk. You're layering your income needs with some growth, some safety, and some optionality. This is where people really win. Not by guessing the market, but by setting it up to work regardless of what happens. And if you're younger, or simply have more time ahead of you, your focus should shift from payouts to long-term growth. This one's for the builders. You'd lean heavily on ETFs like SCHD or VIG, reinvest every dividend, and pair that with total market exposure like VT or S&P 500. You skip the monthly payouts for now, because right now it's about planting roots, not picking fruit. At this point, you might be wondering, which one's best? The truth is, dividend investing isn't about choosing the perfect strategy. It's about knowing what kind of investor you are. If you're someone who needs income today, high-yield strategies give you that comfort. Just know they come with limits. But if you're building for the next 10 or 20 years, dividend growth investing has a superpower: peace of mind. You're not just hoping your portfolio goes up, you're watching your income rise, even when the market pulls back. This kind of investing brings a confidence. Instead of reacting to every market dip, you're collecting and reinvesting, turning volatility into opportunity. That's why so many long-term investors stick with dividend growth strategies. Because they aren't just building wealth, they're building habits, routines, and a more predictable future. And once that mindset shifts, from chasing price to collecting income, everything else gets easier. You don't invest in dividends to grow faster. You invest in them so you don't have to run. If this helped you see dividend income in a new light, the next video you need to watch is called How Tariffs Threaten Dividend Stocks and What to Do About It. Because even if you build a solid income portfolio, policy risks like tariffs can still shake the foundation, especially for dividend-heavy sectors. You'll learn how global trade shocks affect stable companies, how to stress test your income portfolio, and what to do if dividend cuts are on the table. Thanks for watching. Subscribe if you want more insights for your portfolio. And I'll see you in the next video.